JP Morgan, Citigroup, Bank of America, and Wells Fargo are among the names that will be reporting their fourth quarter earnings this Friday. Investors will be keeping an eye on how their mortgage businesses are holding up and listening for signs of optimism on the broader economy. Lots to unpack here with these bank earnings. Guys, is this the quarter where JP Morgan CEO Jamie Dimon again brings out the warning on the state of the economy? He certainly could. He's been, I think, very out in front warning about where this economy might go in 2023. Is it also the quarter where JP Morgan starts to pull back on some of its tech investments given the slowing economy? So those are a couple things I'm watching as pertains to JPM. And then, of course, on news today of Goldman cutting 3,200 jobs. We knew it was coming, but still to see it is I would say, concerning. And how does that CEO, David Solomon, get on that earnings call and project his business looking forward? Yeah, those job cuts coming after we had already seen from JP Morgan and some of the other banks as well, even prior to or during the holiday season, saying that, hey, we're going to need to roll back on some of the bonuses. And that really kind of brings into question what the total compensation package for the existing and the retained base of employees would look like going forward, as the banks are really waiting for deal making to come back in full force, waiting to see where investment banking really kind of regains some type of strength given some of the equity market declines that we had seen in last year. And so with all of that in mind, this earnings period and what they forecast perhaps is going to be the biggest kind of takeaway item in what they're seeing in terms of deal making and where they're going to be able to drum up some type of demand for their investment banking products as well.
Yeah, when we look at the Goldman news this morning, it reminds me a little bit of what we've seen from technology, because part of it is sort of a pandemic payback, if you will. Mm-hmm. That is, Goldman Sachs usually does an annual culling of its underperformers. It cuts them. Didn't really do that during the pandemic. So part of this is sort of now a delayed reaction, a delayed cutting of some of those folks. That's at least some of what is going on there. But we are perhaps going to hear more about cutting from these companies, especially given that maybe they're not totally prepared for what may be coming at this point. For example, Deutsche Bank last week downgrading Bank of America, JP Morgan, and Truist, saying that bank stocks have yet to fully price in a U.S. recession. So are investors fully accounting for the effect this could have on the banks? Are the banks themselves fully accounting for the effect? I think we're going to get lots of discussion around those issues. Right. It seems like there's a disconnect, Julie, because I'm looking at some Morgan Stanley price target changes ahead of earnings. They are cutting estimates on Citigroup and Goldman Sachs pretty significantly. But if you go pull up the KBW Bank Index, as we're showing here, these stocks have gone nowhere, really nowhere over the past year, despite rising yields. And theoretically, that should be good for profit margins. I would argue that chart is suggesting, we're in a recession at some point this year, and that impacts a lot of the businesses beyond deal making for the banks. This runs a little bit counter to what we typically see from some bank activity, at least during a rising interest rate environment. They typically would be more beneficiary, where they can get more money or earn more from the difference between some of the spreads in their loans. And I think for right now, they're still trying to manage what many other businesses are and trying to understand exactly what their cost structures look like. The cut that we're seeing at Goldman is roughly double what we had seen at Morgan Stanley. That was about 1,600 employees there. And so exactly the number of people that they need in order to continue the operations or the business as usual, when business right now isn't kind of that usual operating procedure, if you will, too. Yeah, just to take a step back, if you look at the big businesses of the banks, right? Net interest margin, the difference between what they put out and what they take in, basically, and what they lend, that's going to obviously be a big focus this year. Fee income related to everything from mortgage servicing to the deal making that we were talking about. All of these things are going to be in flux this year and are difficult to predict, I think.